When do you think it actually makes sense for folks to leverage a CPA for their taxes?
I think they should do it right away. I mean, a lot of people try to take it in their own hands and complicate their tax structure before it's necessary and get hurt because of it. So I think, initially you should definitely talk to a CPA right when you're thinking about buying property, just to understand everything that we're talking about right now.
Hey folks, my name is Greg Cullen with Leverage Hustle, here today. Super excited for this conversation with Harris Moore. Harris and I have been working together for several years as CPA, so excited to share some tips and tricks from a CPA perspective to make sure that you can take advantage of taxes, minimize the tax burden, and make the most of your real estate journey. Before I go any further, Harris, do you want to give a quick introduction of who you are and how you got started in the space?
Absolutely. Thank you, Greg, for having me on today. My pleasure to be here. Greg and I have been working together for a number of years, and we've really gone a long way from Greg's first property to however many he has right now. And it's been a learning curve. So I'm happy to be here and share some of the tips and secrets that we have gone through to get him here where he is. So first and foremost, my name's Harris Moore. I have a firm in Boca Raton. We've started about 4 years ago because we've seen a really big need in real estate specifically. We have a large network and community in the area, and we've been helping a lot of clients in that way.
Very cool, man. Well, I appreciate you sharing some of that background. I'm curious. So you and I have worked together a long time. I consider you a very trusted member of my team as a CPA who's very knowledgeable in the space. How do most real estate investors leverage their CPA to get to the next level in their business?
It's a great question. I mean, a lot of times we speak with new investors that are really starting from scratch. They see the hot opportunity to jump into real estate and want to do so, but at the same time are really ignorant to the tax liability to come with the real estate purchase. Property taxes is one thing, but how about insurance? How about all that other nitty-gritty stuff that really adds up as an expense? So I think to leverage a CPA is really to find one that is open to sharing an educational standpoint of how best to do it, how to structure the deal, what to look out for, because there's so many pitfalls that people fall into and suffer because of the lack of education.
Yeah. Harris, it's funny when you're talking about like the Instagram influencers or anybody else who's running these businesses being like, you'll pay no taxes, or like Section 179, a new Rolls Royce, and you can do X, Y, Z. It's like, it's a little bit more real than that. Like you still have to go through the process itself, but some people just don't understand where to start. And I think that's a good segue. It's like when people are getting started in real estate for the first time, what do you recommend for those folks getting their first property? What's most important from a tax perspective?
I think the first most important thing is to understand what kind of property you're buying, who you're buying it with, and structuring it right. Now, depending if you're with a partner, for example, let's say 50-50, and we see a fantastic house, we run a model, we got a great cap rate that we're shooting for, looks good, let's pull the trigger. Well, before you jump in, understand that that's a partnership deal. Potentially a 1065 tax return is going to spark just from you partnering up. No longer is it a Schedule E for an individual. So there's that consideration. There's also the insurance half of it. Do we want to get additional insurance? And that could be a question based on that same structure of the deal. Now, we can get into that later, but that's kind of the detail that you want to look at. But also, there's ways to amend the contract to lean more favorably to the buyer. And in that case, if we were to get in some detail right now, depreciation is a hot topic for real estate. Now, when we're talking about depreciation, land is not depreciable. Now, thinking about that, if we have a scenario where we buy a house for $500K and there's land on that house, you cannot depreciate it. Therefore, we're going to allocate a percentage of the purchase price to the building or house and a percentage to land. Now, you can go aggressive, you can go conservative, being 10%, aggressive being maybe 30%, or you can get an outside appraisal to do it for you. And that's one way to structure that deal. And you input it in the contract so you understand exactly what you're purchasing. And then if you were to dive even further into detail, cost segregation studies. You can even perform one by taking, say, an AC unit that was newly purchased by the seller, adding it to the contract and increasing these assets for future depreciation schedules. Now, I know we're jumping pretty deep pretty fast, so I want to give it a break. And Greg, you asked me more questions.
Yeah, no, this is perfect. I think this is a lot of areas that people forget when they're in real estate to take advantage of. I mean, I think of folks like Donald Trump, who, whether you like him or not, I mean, paying $0 in taxes, especially from a real estate perspective, it's by leveraging some of those losses, depreciation, capital improvements. So I think this is a really great perspective that you have here. Now, how do you think when people are getting started, like if they see they have a brand new AC unit on a house, how would they structure that to make sure they can take advantage of the cost segregation? Would they just jump into a close the property and then immediately just do a cost segregation study?
I think that doing the cost segregation study in the initial purchase year is the most advantageous. However, there are cons to doing that. And that's one thing I also want to highlight. Cost segregation studies are famous for writing off the majority of the purchase and not paying taxes in that year and potentially future years. But the caveat comes into play when you sell that property. When you sell the property, there's something called depreciation recapture. That's where you have to bring back the depreciation expense that you've used in prior years as a tax advantage, and you pay additional taxes. So generally, you're looking at 25% of all the depreciation that you wrote off. It pulls you back. The tax guys come in and say, hey, you got to pay that tax. And if you did cost segregation, bonus depreciation, 179, you're going to pay potentially up to 37% in taxes. So that ordeal or decision to do that cost seg really is dependent on your goals of what to do with the property, whether it to be flipped or held in longevity. I think if you want to flip a property, do not do the cost segregation just because you're going to hit with all these taxes on that sale. However, if you do want to hold it for a long time, then potentially the cost segregation study would work.
Good to know. I appreciate that. Now, let me ask you from an overall perspective, how do you think CPAs can help everyday investors minimize the tax burden for their homes? I know we talked a little bit about bonus depreciation, cost segregation studies, tax write-offs. Sometimes it can feel overwhelming for investors getting started, but generally, what's the best thing that you advise people to pay little to no income taxes on those real estate holdings?
How do you pay no taxes? That's what I'm gathering from this question.
Right? That's the question. How can you pay no taxes by using a great CPA?
So I think a lot of that comes down to education and just speaking with a CPA, your personal CPA, whoever it is, and them guiding you through, the motions of step 1, 2, 3, how to look at things. It's going to take many hours on your own end to do your research because there's so many things that your CPA just doesn't have the time to talk about. We're here talking about this now, but we can talk about this for days. Cost segregation studies in detail, how to perform that without even hiring an engineer. We can kind of incorporate that into a contract on the buy or sell. Being aggressive on how to allocate that land percentage of the purchase price versus the building. It's all the small things that really add up. So I don't think it's one thing in particular. It's really understanding all the rules and statuses that you have available to you, understanding the repercussions, and then also understanding your personal situation and tying it all together. Now, again, that CPA is not going to know everything. And depending on yourself, you have to provide them that information for you and your CPA to work well together.
That's good to know. Harris, a few more questions for you before you start talking a little bit more about, next steps with people working with someone like you. Curious, what are some other ways that CPAs can work with a real estate investor to push them to the next level? Whether it's from, it could be a record-keeping perspective, tax strategy, overall challenging them and just, holding them accountable. How else do you recommend working with some folks to get them to that next level?
Yeah, that's a great question. And I think initially, record keeping. Record keeping is so important. And for investors, that's kind of the last thing they're thinking about. They're looking at deals every day, what cap rate's good, what's not. They're keeping up with the markets, more or less. And when you have your property, let's say the first one, it's so important to list out all your expenses, have everything separated from your business card to your personal card, just so you don't miss out on all the deductions that you're spending on. So get that business account on your, you have your personal bank account, open up that business line, and then spend only on business, segregate those expenses, and that's so much better. Now you can do QuickBooks to track everything, or you can do a simple spreadsheet. So I think it's more or less about educating yourself on the expenses that relate to a Schedule E specifically, that you can get a write-off for, and instead of taking a stab at it yourself and, maybe I have an expense for paper or a chair or something like that and having 1,000 different line items. Well, you should, but you should also summarize them in IRS dedicated expense categories. That'll make it easy to understand, easy to put in a profit and loss statement to understand where you're at month to month, and easy to show your CPA or anybody else, maybe investors that you're potentially looking to syndicate a property with. Well, hey, now I have a report I can show you any month and you can read it, versus here's my shoebox filled with receipts. Have fun with that.
Yeah, makes sense. Thanks, Harris. A couple questions. I feel like we've asked a whole lot of questions as it relates to just real estate in general and taking advantage of some of these tax codes out there. But I just want to take a bigger high-level view of working with a CPA and ask you a couple questions. So when do you think it actually makes sense for folks to leverage a CPA for their taxes?
I think they should do it right away. I mean, a lot of people try to take it in their own hands and complicate their tax structure before it's necessary and get hurt because of it. So I think, initially you should definitely talk to a CPA right when you're thinking about buying property, just to understand everything that we're talking about right now. Everything's important, not just after you buy the property, but during the purchase. So speak to the CPA before you make the transaction, because then potentially you can be saved from making a mistake.
Yeah, for sure. Now, for folks who are just looking for a new CPA, whether they're a real estate investor or an everyday person, what type of questions do you think those folks should be asking when they're looking for a new CPA?
Yeah, that's a good question too. I mean, you should definitely have a CPA that's knowledgeable about real estate, but how to understand how knowledgeable your CPA is important. So I think a couple questions that you can ask them would be, hey, have you ever worked with underwriters before? Do you have clients or connections that are realtors, other real estate investors just like yourself? And then you can probe them around questions like, oh, have you ever seen a cost segregation study? And if so, can you tell me how that works? In the meantime, you should already know how it works and expect the right answer. And if they don't tell you the right answer, then you automatically know, hey, this guy or girl isn't for me. Let's try another CPA. So have your questions ready, but at the same time, have the answers ready beforehand.